Hey there, everybody. In this video, I'm going to do a recap of discounted cash flow valuation, where we try to figure out what the price of a share of stock should be. I did a couple examples of this a few weeks back. One I did up on the board. I kind of wrote out all the numbers, and we went through that. And then another example we did down in the computer lab. So we're going to take another crack at this. But this time we're going to work on one of our companies we've selected for our financial ratio analysis, right? So we all looked up those 10 companies a couple weeks back. I want you to just focus on one company, maybe the one you're most interested in investing in, or maybe one that you think you might work there someday. And we're going to do this detailed analysis for that one particular company. So all of you will be doing different companies. Try to select one that really interests you. And what I did in the past was I gave you kind of information about the company. So this column here, past year, I added this since the last time we looked at this. And this is kind of your starting point. So what you want to do for your company is go look up their most recent financial statements. So again, that's that 10K. You can go to the sec.gov Edgar website, that same site we went to in the past to dig out all the information on our financial ratios. So go to those financials for the one company you select and look at their most recent information. Then whatever amount they have for sales or revenue for the past year, all right, input that into this column right here. All right, and then I want you to look at all the expenses the company had up to the point where they paid taxes. So all expenses before taxes. And we're going to put those expenses in these next two areas. So what you want to look at, if your company had, let's say, like $85,000 in total expenses before tax, I want you to break that figure out in two amounts. The one amount is the depreciation expense, which should be listed right on our income statement. And then all the other expenses put in this category here. So if we had $85,000 in expenses before taxes and $5,000 was depreciation expenses, well, I want to list out that depreciation separately. So the $5,000 goes there and all the rest will go in the other operating expenses. Notice then we have a pre-tax income column. And what that's doing is just taking your revenue and subtracting your expenses. All right, so this company had $15,000 in income before tax. Now, remember, one of the tricky parts of the process was you have to go back and re-add your depreciation. So if we subtracted out $5,000 up here, we're just going to re-add it back in. Now, that doesn't matter so much for the current year, but it's really going to matter going forward from year one. And we're going to do 6 years for the purpose of this project. So we're going to try to calculate or kind of guesstimate what we think revenue and expenses are for the next 6 years for this company. So the reason I gave you these introductory figures was we're going to use this as a base. All right, so whatever company you have, you're going to enter your information for that particular company in this column, and that gives you a starting point. And so part of this is kind of not just doing the mathematics, but having an appreciation for the business the company's in, the industry they're in, current macro trends. You're going to use all that information to try to predict how this company is going to do financially over the next few years. So for this particular company, they had about a 5% growth rate in the recent past. So I just made their sales, I predicted they're going to go up by 5% each year. And I did the same thing with their expenses. I predicted those were going to go up 5% each year. What you can do to justify your predictions is look at the recent past, see how much sales have gone up over the last couple years, see how much expenses have gone up over the last couple years, and then try to estimate, do we think we're going to have this level of sales growth or this level of growth in expenses over the next 6 years? Now, maybe you will have a constant rate where it just goes up 4% or 5%, or you might think that a particular company, they're going to grow really quickly over the next couple years, but then in year 4, it's going to kind of start to slow down a bit. Whatever you want to use is fine. I just want you to justify it. All right, so part of this project is you're going to complete the spreadsheet. We want to figure out what the true value for a share of the stock is. And then I want you to do a one-page write-up just talking about why you used the numbers you did use in this spreadsheet. All right, so for our purposes here for this particular example, I just had the sales go up by 5%. I had the expenses go up by 5% because that's what happened in the recent past with this company. All right, so I want you to use your own judgment to try to predict, all right, the financial expenses and revenues for your company over the next 6 years. All right, so that's really going to be kind of the top part of the spreadsheet, right? Just filling in these columns here. Notice I used just a constant depreciation amount. You could just use the depreciation from the current financial statement and use that across the board. That's not the most accurate way to do it, but I'm trying to simplify the process a little bit here until we get the hang of this. So you could use a constant depreciation rate, but just make sure you're showing the change in sales and operating expenses over the next 6 years for your company. All right, so one of the things we want to do once we make all those predictions and we kind of fill in the spreadsheet, and notice again, I went through this in the computer lab a couple weeks ago, but if we are saying that something's growing by 5%, notice my sales were 100,000, they went up to 105. If I click in on that formula there, what I'm doing is just taking the previous amount, that D7 represents cell D7, the D column and the 7 row. All right, so it's taking that 100,000 in D7. I'm multiplying it times 1 plus that growth rate. So that's basically just our future value formula we looked at, right? You take the amount times 1 plus the growth rate. Well, if I had 100,000 last year and it grows by 5%, this little calculation should give me the answer. And we'll see it's 105. All right, I just did the same thing for year 2. All right, I took this number times 1 plus 0.05. All right, we get 110,250. Again, you don't have to use 5%. If you do, I just want you to justify why you use that number. And you don't have to use a constant rate. I used a 5% growth rate for every year. You could have it grow 3% for the first couple years, then it grows more for the last couple years. Really, you're basing that prediction on what you think's going on with this company and with the industry. And we could have 2 different people look at the same company, have the same figures, and they could come up with different growth rates, and there's nothing necessarily wrong with that. Some of this is your kind of subjective opinion about what you think is going to go on with this company. So once you make those predictions about the growth rates and you get all your numbers in for the 6 years for sales, depreciation, and other operating expenses, the next part of that process is adding back depreciation. So the reason we made a special entry for depreciation here, we could have just had all the operating expenses, including depreciation there, and not break it up, but we need to add back depreciation. Remember why that is. Depreciation is a non-cash expense, right? So we might have bought equipment years ago, paid the cash years ago for the equipment, but we're slowly taking that expense over time. Remember, depreciation spreads out the expense over the life of the asset. So even though we have a $5,000 hit to income here, we didn't necessarily spend $5,000 last year. All right, so we're adding that back. So basically what you're doing here for every year, you're just taking the depreciation amount you had, 5,000 in this case, and I'm adding it back here. So if we look at year 1, we had 105,000 in revenue, we had 5,000 in depreciation, we had 84,000 in other expenses. So we were taking that 105 minus 89 to get our pre-tax income of 16,000. The problem is when we do these calculations, we're not directly interested in pre-tax income. We're interested in free cash flows, so how much cash is available to the company. So to back into that, we need to add that depreciation back. So I'm taking that 16, I'm adding the 5. All right, I get 21 as my free cash flow. All right, I'm just doing that same process for each of these 6 years. So we make our predictions on what we think the cash flows are. All right, we figure out what the pre-tax income is. Then we add back our depreciation. Notice I do that for every year. And then in the very final year, year 6, all right, basically I'm adding it and then subtracting it out. So these two numbers just cancel. I'm taking the 21.8. I'm adding the 5 for depreciation because that's a non-cash expense. But if we're going into the future growing at a constant rate, all right, we need to buy equipment eventually. All right, so we do need to make up for that equipment that's been used. If we're actually doing a real life analysis, we do a lot of in-depth study of the company, how much capital they've used, the type of capital, how quickly it depreciates. We're not going to get that in-depth. I just want you to plug a couple numbers here for today, and we'll kind of talk about more of the details of this process later on in the course. Just for now, we're trying to get used to this process of trying to value a company. All right, so long story short of this column for year 6, just add the depreciation, then subtract it out. Notice on net, those two numbers are going to cancel each other out. And that 21.8 you have up here, you have the same number down there. And what this is saying is we think, all right, in year 1, we're going to have 21,000 in free cash flow, 22,050 in year 2. All right, notice by year 6, all right, it's 21,801. We assume that's what our cash flow is going to be into perpetuity. All right, so I'm figuring year 7, 8, 9, all those years we're making 21,800 in free cash flow. That's a big assumption to make, to say the cash flow is never growing. Again, that's a shortcoming of doing it in this way, but we're gonna kind of make that assumption to make the process a little bit easier. And professional analysts do the same thing. They might go out 10, 15 years, but at some point they just assume constant free cash flow, because it's very hard to have an accurate prediction of what's going to go on with a company 7, 8, 10 years out. So I think 6 years is a good window for what we're doing. So notice what we want to do to try to figure out how much the company is worth. We're looking at the present value of all the free cash flows the company is going to earn. All right, so that's what I'm doing right here. Notice we have $21,000 that the company is going to have at the end of year 1. Well, keep in mind that idea behind present value, right? We discount that amount because $21,000 that the company earns at the end of next year is not the same as having $21,000 in your pocket right now. So we have to take the present value. So remember how we do that. We just take the number divided by 1 plus the discount rate, raised to the number of years out. So for your purposes, you can use a 10% discount rate. You can feel free to use that one. If you want to do some research and try to figure out what the accurate discount rate is for your industry, all the better, but you don't have to do that. So we're assuming the discount rate's 10% for your company. Notice I have the shares outstanding. For my company here, it's 2,000. You're going to pull this information from your financial statements, right? So you actually want to use the number of shares that your company has outstanding. So feel free to use this discount rate, but do not use this 2,000. That will give you very, very bad information for your company. So actually find the amount of shares your company has, and we're going to use that. And that's going to come in the very last step of this process. All right, so this 21,000, again, we're going to discount that. So notice the formula I used to do that. I take the 21,000 in this case, and I divide it by 1 plus the discount rate. So that's what we have right up here. 21,000 divided by 1 plus 10%. And notice it's raised to the first power. I didn't even really list that out. If we do that, raise it to the first, we'll see we have the same number there, 19,000. I just do that same process for the next 4 years. So notice year 2, same idea. We're taking that 22,050. We're going to divide that by 1.1, but now notice it's raised to the second because we're getting that 22,050 at the end of year 2. All right, so we're just looking at these cash flows when they're coming in, discounting them back into present value. So that $22,050 we're due to receive at the end of year 2, it's worth $18,223 in today's dollars. And the total value of the company, what it's truly worth, is just the sum of all the discounted cash flows it's going to earn in the future. That's what we're doing, trying to figure out how much the company is going to make each year in the future, discount that back into today's dollars, and add them up across the board. So I just do the same process for year 3. Notice you discount it, you raise that to the third. Year 4, same idea. Year 5. Where it gets a little bit tricky is year 6. The reason is we're saying in year 6, this isn't just how much money we're making in year 6. We're saying we're making that much money every year as long as this company exists into perpetuity. All right, so what we could do is a shorthand calculation to figure out the value of a perpetuity. Remember, we did this for our first test, right? All you do for a perpetuity, if I'm getting $21,800 a year forever, and I want to know what that's worth to me, all right, well, I just take that amount and I divide it by the discount rate. So that's the present value of a perpetuity. So that $21,800 that I'm due to receive every year from year 6 beyond, all right, in total, all those cash flows added up are worth $218,000. As of the end of year 6, they're worth $218,000. So the next part of that process, well, we need to discount that $218 back into today's dollars. So you can see I do that same idea as what we did with these other ones, other cash flows. I just discount it back. I look at the number of periods. Well, it's 6 periods, so I divide the total number by 1.1 raised to the 6. So again, with that last year, we got a special process, right? We take that 21,801, we divide it by the discount rate of 10%. That's the value of the perpetuity. That's the total value of all the cash flows this company is due to receive from year 6 on. And then we find the present value of that amount, all right? So we do that by dividing it by 1.1 raised to the 6th. Notice, so we take that 123, we're going to add that together with these other discounted cash flows, and that's where we get this 210. Notice I'm just adding all those together in the formula. All right, so the total value of this company is a little over $210,000 based on all the cash flows we predict we're going to receive throughout the life of the company. Now, that's great that we have that information. If you're looking to buy a company outright, maybe you're looking to buy this Steel Cities Builders company, well, you know what the company's worth based on your analysis. So if the owner wants to sell it to you for like $175,000 and you think it's worth $210, that's a good deal. If they're asking $300,000 for it, well, you're not going to want to buy it. You're not going to want to pay $300,000 for something worth $210. Now, we're typically interested in looking at a share price, right? Not the price of the entire company, because most of the time as investors, we're not buying entire companies, we're buying shares of companies. Well, notice I could figure that out pretty easily. I know the whole company's worth $210,000. Well, there's 2,000 shares outstanding, so all I have to do to figure out how much each share is worth is take the entire value of the company, divide it by the number of shares. And notice that's what I do right here. D17, that's the total value of the company, 210, and I divided it by that 2,000 shares. So for this company, each share is worth $105.